Hello, good morning, warm welcome to your decoding of the ET Wealth newspaper. I'm Priyanka Bhatia from Women on Wealth, and today we are yet again going to talk about one news that has come in the ET Wealth newspaper. We will decode it, understand it, and see how we can use it for our own money life. The bull run is on. What is the bull run? When the markets are going up and up. So the stock market has been just moving up and the bull run is on, and there are many mistakes that people do at different times. So ET Wealth is talking about all these mistakes that you can avoid in this bull run. And today we are going to talk about those mistakes. So it is saying that existing investors are assuming that the recent historical returns will be repeated, while a new set of investors are getting ready to jump in, lured by high returns earned by their friends and relatives. But retail investors commit their worst mistakes during the bull run like these. We reached out to the investment experts to know some of the common mistakes that we can see investors make. So it is saying that yes, a lot of people have entered the market, and with the entering of the market, with the new entrants entering the market, there are many mistakes that they can commit, and this is an attempt to help them out. So let's go forward with that. Bhagya, Preeti, Christina, Nihara, Rohini, welcome everybody. Let's begin. So the first mistake that ET Wealth is talking about is chasing high priced IPOs. And the second mistake is falling into the NFO trap. So I'm going to now share the details. IPO is initial public offering. And this is when when a company is listing for the first time in the stock market, it's called IPO. So when a company which might be running for a long time or a short period of time, when it is now entering the stock market, IPO is released. When a new mutual fund is entering the market, that's called new fund offering, NFO. And ET Wealth is saying that new investors should avoid IPOs and NFOs. And I am of the same view. You all know that I keep meeting people, I keep talking with them, new people, beginners mostly, and I hear a lot of questions coming from them on cryptocurrency, on stock market trading, and it always, surprises me that financial foundation is lacking and beginners jump to advanced concepts like IPOs, NFOs, and that they have no business getting into. And I feel the same. So when I'm saying beginners or new investors, I mean people who are investing, say, for 2-3 years with their knowledge in the community here, or people who have just recently done the program or are doing the programs. Guys, this is not for you. IPOs, NFOs, and I keep repeating them in the program as well. There are already well-established businesses, well-established, huge, good mutual funds with huge track record, and all of us need to be first building a strong financial foundation, a robust financial foundation with these. It can't be that you can jump into newer investments, all these shiny objects, without building the ground floor of your building. So if you're jumping to cryptocurrency or you're jumping to IPOs, new fund offers, what you're actually doing in reality is trying to build the first floor of the building without building the ground floor. And you will not manage to build it. I am sure you know enough people, enough stock investors, enough investors who have lost their money. It's because they never built their knowledge, they never built their financial foundation. Now, while ET Wealth is not talking anything about financial foundation, I would like to bring this concept for each one of you. If IPOs are not a part of the financial foundation, If NFOs are not the part of financial foundation, then what is a part of financial foundation? Number one is, do you have clarity on your financial goals? Do you have absolute clarity on where you need to be and in what time period? And how much money would that cost? Do you have the inflation adjusted goal amount calculated? That's the first part of financial foundation laying. The second part is understanding your financial situation. Understanding what is my investment portfolio currently. How did I build it? Did I build it on tips? Did I build it on hearsay? Do I do last minute income tax planning? Am I dependent on others to tell me what I should be doing for my income tax planning? Have I chosen the right investment instruments which actually take me to the goals and the goal amount that I have calculated after adjusting inflation? Do I understand the knowledge gap that exists where I am? Do I understand the art of building my financial plan? Do I understand the power of compounding? Do I understand how to build a well-diversified investment portfolio? Do I understand what my asset allocation should be with regard to different investments and reaching the goals? Do I have a model investment portfolio built? Do I understand the step-by-step methodology to pick good quality mutual funds, stocks, other investments like gold? So these are just some starting points that we all need to take care of if we want to become intelligent investors, if we want to actually make our money work for us and reach our financial goals. There are no shortcuts to this. We need to first build the ground floor of our building when it comes to finances. IPOs, NFOs are the first floor. Let me talk about myself. I am not applying for any IPOs, no matter how many are coming this year, the next year. I have not applied even for one. And to tell each one, I have a very, very strong, very robust stocks portfolio, which is generating, I have more than doubled my money in most of my stocks. And I don't think sitting where I am that I need an IPO or I need an NFO. I don't think so. What I believe is that I need good, strong, quality investments, and I need to persist with those investments and then reach my financial goals. I don't run after any shiny objects. Jina, Sangeeta, Bindu, Rupal, Raksha, Ridhima, Ishika, good morning, warm welcome. Coming to the third mistake that ET Wealth is talking about, it is saying buying into hot sectors. Now, just because a sector is moving, you buy into it, that's not the way forward. Let me give you an example. So our community and I, we saw that there was a certain company which was doing extremely well. It was a strong company, strong business, and it was in the chemical sector. And this is the time when chemical sector wasn't like the booming sector that it is today. And we bought this company, excuse me, and this was in the mid-size segment. And we bought this company and, we discussed it in our community. And then after we bought it, after a couple of years of buying into this company, the chemical sector began to rise. And then we began to profit more and more with, of course, the chemical sector becoming the hot sector and then it becoming like one of the top performing sectors in one of the most top picked sectors by mutual funds. So, just running after different sectors, newer sectors, emerging sectors, hot sectors is not the way forward. Use the bottom-up approach. Pick the right companies. They may be in different sectors. That sector may not be booming right now, but the time will come. And can you persist with that? Let me give an example. Pharma sector wasn't doing well. for so many years, and then the pandemic hit us, and pharma sector, we all know, touched the roof. So we can't be running after hot sectors. We need to run after, or rather, why should we be running after anything? We need to just pick some good quality companies, good quality mutual funds, gold investments, good income tax planning instruments, good asset allocation. If we can do all of that, there'll be a very, very strong return producing portfolio that you can build over time. So I stay away from buying the hot sectors. Of course, I don't mean that now I know that banking is going to drive the economy. Okay, any economy that has to grow, banking and finance are top sectors. If banking and finance don't grow, we ain't growing. The digital transformation that got accelerated because of the pandemic is another sector which is going to do extremely well. So not that we don't look into the sectors and we don't stay aware and educated. That's not the point. The point is we don't run after just the hot sectors. That's something that even I stay away from. Betting on concentrated portfolios is the fourth mistake that ET Wealth is talking about. So, and it is giving a good example of one of the mutual funds. I will not take the name of the mutual fund. This mutual fund has been underperforming, and it has had only 11 stocks in its portfolio. And it's underperforming, it's performing comparatively lower to its benchmark. For everybody who's done the Money Gym program, you know I'm talking about mutual funds, and you know what is a benchmark, etc. other things. For people who are new, don't be scared. You will learn all of this, okay, over time. So this fund, this mutual fund has a concentrated portfolio of just 11 stocks. Now, and it is underperforming, and clearly there is too little diversification and too much concentration. We've seen in all the best quality mutual funds that we've selected in our Money Gym program and the community, we've seen that a good diversification is about 30-35 stocks in a mutual fund. And that mutual fund has been doing extremely well. So again, coming down to understanding diversification, concentration, understanding mutual funds, their portfolios, what are they buying into. You don't buy mutual funds just on hearsay. Just because somebody said that this mutual fund is good to invest in, you will invest in it. No. If mutual funds give returns like this, then everybody would have been a wealth creator by now. But there are hardly any women who have created wealth by following tips. So we all need to understand that's not the way forward. Then shifting completely from funds to direct stocks. So one of the mistakes people make is they completely shift from mutual funds into direct equities. They will also shift from all the fixed income instruments into direct equities. Diversification is important. Understanding what stocks I am buying, which stocks are the mutual funds in which I am investing are buying, how my portfolio is diversified, and then how am I balancing between equity, gold, fixed income, savings, fixed deposits, and more. Okay, so this is all pretty critical. These are all critical steps when we are beginners or we have just started out. Like I said, 2-3 years into the investing journey, consider yourself beginners only. Okay, resorting to trading, intraday trading in stock investing. Well, I don't do it, and I don't think I need it. I don't think anybody who has a regular income needs it, or anybody even who is a homemaker doesn't need it. We can make far more money and we can generate far more returns by becoming long-term investors than doing all this buying and selling constantly. One of the mistakes that ET Wealth is talking about, which is not booking partial profits in a bull market. I don't agree with this one. I don't think this is a mistake. Okay, I do not agree with this. It is saying that a common mistake that retail investors make is not booking partial profits in a runaway bull market. Do we know that this is the maximum point? Like, do we know that, okay, after this the market ain't going to go up? Nobody knows the future. So who knows this, who knows the market is going to go further high and we are cutting our profits short by selling now. And when to sell your funds or stocks? Is it that when the bull market has arrived or we are in the middle of a bull market, we should sell? Is that a reason to sell a fund or a stock? I don't think so. If you are a long-term investor, you have the patience, you have the vision, you have selected good quality funds and stocks and other investments, you've built a well-diversified investment portfolio. Actually, the time to sell that good quality investment is never. Number one. Number two, if your goal is just now 2-3 years away, yes, it's a good time to sell. It makes sense to move from equity into fixed income. Or, your diversification, say the bull market has actually led to your asset allocation becoming too high in equities. If that is what has happened, then maybe, you want to move from equity to fixed income to balance your investment portfolio. But this you need to be doing only if your asset allocation has gone over and above 75% in equity and you are aging. The average age of our community is between 27 and 40 years.